So you're staring at a page of raw financial statements, trying desperately to memorize like 20 different accounting formulas, and you are completely missing the actual story those numbers are screaming at you.
Oh, absolutely. It's overwhelming.
Right. And if you're crammed on a commuter train right now or stealing 10 minutes of peace on your lunch break to study, I mean, this is the ultimate frustration. It feels like this impossible, exhausting memory game where just one forgotten denominator fails the entire question.
Yeah, that panic is real.
But what if passing the exam isn't about memorizing the math at all? What if you realized that every single ratio is just a clue to a much larger corporate mystery?
Well, when you look at it that way, everything changes. I mean, you stop being a human calculator and you start acting like a financial detective. You're looking for the motive behind the numbers.
And that is exactly what we are doing today. Welcome to everyone joining this deep dive from across the globe. Today, we are tackling the FMA and MA Management Accounting paper, and we are locking in on ratio analysis.
Our mission today is highly specific. By the time we wrap up, you won't just be plugging numbers into a formula to find a key accounting ratio. You will be able to confidently explain what that ratio actually measures and, crucially, exactly what those values mean for a real, breathing business.
Yeah, because we know you're balancing incredibly busy lives. You have careers, families, and you're pushing through your ACCA goals. So this deep dive is custom built for you, wherever you are in the world right now, to give you the actionable insights you need to walk into that exam hall with confidence.
So let's start by grounding ourselves in what this actually is. Ratio analysis is basically the skill of using ratios and percentages to assess the performance of an organization. It takes raw financial data and translates it into actionable insights about a company's health.
Okay, let's unpack that, because to me, it's exactly like getting a medical blood test.
Okay, I like that.
Right, because a raw number on a lab report, like a cholesterol level of 150, I mean, that means absolutely nothing to me on its own. I don't know if I should celebrate or call an ambulance. But when that number is presented as a ratio, compared to a healthy baseline, it tells the doctor immediately if the patient is thriving or in critical condition.
That is the perfect way to visualize it. I mean, without context, a number is just useless. A company reporting $1 million in profit sounds fantastic until you realize they invested $1 billion to get it.
Right, then it's a disaster.
Exactly. It's the relationship between two numbers that gives you a true diagnosis. And what's fascinating is that sometimes the diagnosis completely contradicts your initial assumptions.
Oh, for sure, and here's where it gets really counterintuitive. I was looking through our source material, and it points out that having a massive pile of cash sitting in the bank isn't necessarily a good thing.
No, it's really not.
Which is wild to me, because my immediate instinct is always, well, more cash equals a safer, stronger business. If I have $10 million in the corporate account, I'm safe from bankruptcy. How is that ever a bad thing?
It feels wrong, doesn't it? But in finance, cash is actually considered an idle asset.
An idle asset?
Yeah. If a company's current ratio is extremely high, indicating they have vast amounts of liquid cash compared to their immediate debts, they might just be acting completely wastefully.
Wasteful by holding on to cash. I feel like that concept alone is going to trip up a lot of people in an exam scenario.
It definitely does, because we are all taught to save our money. But think about the mechanics of a business. Cash sitting in a standard bank account earns practically no return, right? And it's actively being devalued by inflation.
So true.
Carrying too much cash means the management team is missing out on opportunities to reinvest that money into new technology or marketing or expansion for higher returns. Or, it could indicate that the company is completely ignoring cheap, short-term finance options to fund its daily operations.
Okay, so the business is essentially leaving money on the table out of an overabundance of caution.
Precisely.
But if hoarding cash is wasteful and having no cash is deadly, how do we know what the right balance actually is?
Well, that is the exact tension examiners want you to figure out. And it's precisely why this topic is so heavily featured in the FMA and MA syllabus. Candidates are required to discuss and calculate measures of financial performance because it bridges the gap between basic mechanical math and high-level business strategy.
Which makes it globally relevant no matter what industry you end up working in.
100%.
I mean, every real-world company needs to generate profit to give their investors their required returns, and they need those funds to reinvest back into the business. Without these diagnostic ratios, Investors and managers are essentially flying blind.
They really are. So when it comes to the exam strategy, you are expected to calculate the ratio, know what it measures, and, this is the part most people miss, explain what particular values mean for the business in question. The calculation alone will never secure you a strong pass.
So for the person sitting there sweating in the exam hall, it's not just a memory test of long division.
Far from it. The examiner isn't just testing your math to ruin your weekend. They want to make sure that when you step into a real corporate role, you won't accidentally sign off on a strategy that bankrupts a company because you misread its financial pulse.
Well, to avoid accidentally bankrupting anyone, we need to understand the three main diagnostic pillars that examiners focus on. Let's break this down into three clear parts.
Okay, let's walk through them. The first pillar is profitability. This focuses entirely on an organization's ability to deliver returns. So we're looking at metrics like return on capital employed, return on equity, and various profit margins.
Simply put, it measures an organization's ability to actually make money and reward investors for the risks they are taking. But making a profit on a spreadsheet doesn't guarantee you can actually keep the lights on tomorrow.
No, it doesn't. Which is exactly why a highly profitable company can still go completely insolvent. And that brings us to the second pillar, which is liquidity.
Okay, liquidity.
Yeah. This focuses on short-term financial obligations. We use the current ratio and the quick ratio to measure this. Simply put, it assesses if the company actually has enough accessible cash to safely pay its immediate liabilities within the year.
Exactly.
But if a company is highly profitable, why would it ever run out of cash?
And that is the perfect segue to our third pillar, activity, which is also known as efficiency ratios. This focuses on how well management is controlling their assets. It measures things like inventory holding periods, receivables collection periods, and payables payment periods.
Simply put, it measures how efficiently a business converts its assets like inventory sitting in a warehouse into actual cash or sales. If I'm thinking about this right, profitability is the engine's horsepower, liquidity is the fuel in the tank, and activity is how well the gears are turning.
That is a highly accurate way to visualize how interdependent they are. You need the margin, you need the turnover, and you need the cash. All three must function together or the business collapses.
So I want to see how all these gears turn together in a real global business scenario. What does this look like in practice? Let's picture a massive global retail organization. We are assessing their performance, and retail is a fascinating sector for ratio analysis because it has a very specific financial footprint. Retailers generally have extremely high asset turnovers, but that is usually accompanied by very low profit margins.
Okay, that makes sense. Like a supermarket, they're selling a massive volume of goods every single day, turning over their inventory rapidly, but they might only make a few pennies of pure profit on each individual item they sell.
Exactly. So let's put some numbers to it. Imagine this retail business has an operating profit margin of just 5%.
Which sounds incredibly low on its own.
It does. But they have an asset turnover of 2, meaning over the course of a year, they generate sales equal to twice their total capital employed.
Okay, here's where the math really tells the story. Because the vital mathematical relationship here is that your return on capital employed, your ROCE, equals your operating profit margin multiplied by your asset turnover.
Right.
So we take that 5% margin, we multiply it by the turnover of 2, and we land on a 10% ROCE.
Yes, and that mathematical link is critical. It proves that any change in an organization's ROCE is always explained by either a change in their margin, a change in how fast they turn over their assets, or a combination of both.
So even with a tiny 5% margin, because they're turning over their entire capital base twice a year, they were still generating a solid 10% overall return. The volume is making up for the margin.
Precisely. But let's dig deeper into the operational side of this company, specifically their activity ratios. Let's say the same company has $20,000 in average accounts receivable, but their total annual credit sales are $40,000.
Wait, hold on. Let me just do the math out loud so we can visualize this. They have $40,000 in total credit sales for the year, but $20,000 of that is sitting in accounts receivable.
Yep.
So that means exactly half of their yearly sales are just sitting there as IOUs. If we look at a 365-day year, half a year is about 183 days. They are waiting roughly 6 solid months to actually get cash from a customer after making a sale.
Exactly. You've just diagnosed a massive drag on their liquidity. For liquidity purposes, the faster money is collected, the better the business functions. Furthermore, the longer customers are given to pay, the higher the probability that some of them will default, leading to bad debts.
This is where the real-world application of the syllabus shines, especially depending on where you sit in the company.
Oh, definitely.
Like if you are an early career analyst looking at these activity ratios, you realize you are walking an operational tightrope. If you aggressively push your customers to pay way before that 183-day mark, you might seriously damage your relationships and lose future sales to a competitor who offers better credit terms.
That's a huge risk.
Right. But on the flip side, if you try to preserve cash by keeping your inventory too low, you risk stockouts, empty shelves, and creating an entirely different group of angry customers.
It is a constant, delicate balancing act. Now, let's zoom out to the senior professional angle. A senior manager or an investor is looking at that overarching 10% ROCE we calculated earlier. Earning a return on capital is an absolute necessity to reward investors for the risks they are taking.
Right.
So the senior manager's job is to compare this 10% return against alternative investments of a similar risk profile in the wider market.
Because risk doesn't exist in a vacuum.
Exactly. They have to ensure that both the debt investors who lent the company money and the equity investors who bought shares are being adequately rewarded. If a completely risk-free government bond is offering 5% and another competitor in the same sector offers 12% for the exact same risk, well, that 10% ROCE suddenly looks very weak, regardless of how fast the supermarket shelves are clearing.
And bringing this right back to what you will face in the exam hall, an examiner will give you these exact figures. They will give you the 5% margin, the turnover of 2, the 20,000 in receivables. But they won't just ask you to calculate the 10% ROCE and move on.
No, they won't.
They will ask you to explain why the ROCE moved from last year to this year. They are expecting you to diagnose whether it was the pricing strategy that slipped or the inventory turnover that bogged down.
They want you to act as that diagnostic physician for the business, interpreting those blood test results in the context of the whole patient.
So that 183-day collection period is a glaring issue for our fictional retailer. But diagnosing it brings us to the most glaring issue candidates actually face on exam day.
Yes, the trap that catches almost everyone off guard.
When you're sitting in the exam hall, the clock is ticking down, and you feel the pressure, your panic instinct is often to just grab the first profit number you see on the income statement to finish the formula. And here's where it gets really interesting. Candidates completely mess up which profit and capital figures to use when calculating return on capital employed.
It happens in almost every exam diet. Candidates grab the wrong profit figure from the top half of the statement or the wrong capital figure from the balance sheet, and the entire calculation falls apart before they even begin the written analysis.
I have to play devil's advocate here. Why is this so difficult? Isn't profit just profit? You look at the bottom line, you see what the company successfully made for the year, and you use it to find your return.
That assumption right there is exactly the trap. Profit is not just one monolithic number. The golden rule of ratio analysis, the absolute bedrock you have to build your exam strategy on, is that you must always compare like with like.
Compare like with like. Okay, how does that actually apply to ROCE?
For ROCE, you absolutely must use profit before interest and tax, PBIT. Some people call it operating profit.
But why before interest and tax? Why not use the profit after everything has been paid?
Think about the company like a pie. PBIT represents the total size of the profit pie that is available to pay both of your major investor groups. It pays the debt investors who are legally entitled to their interest slice first, and it pays the shareholders who get the dividend slice from whatever is left.
Okay, I'm with you.
Because you are looking at the return generated for both groups of investors combined, you must divide that PBIT by the total capital employed. And total capital employed is your long-term debt plus your total equity.
I see it now. The top number in the fraction, the PBIT, hasn't paid the debt holders yet. It still includes their money. So the bottom number in the fraction, the total capital, has to include the debt holders' initial investment.
You've got it, like with like. If you make the mistake of using profit after tax, you have already paid the interest out to the debt holders. That money has left the building.
Right.
So if you divide profit after tax by the total capital employed, which still includes the debt, you're comparing apples to oranges. You're comparing a profit pool that belongs only to shareholders against a capital pool that belongs to everyone.
And if you do that, the examiner is going to hand you a lemon of a score. It fundamentally shows you don't understand who the money belongs to.
Exactly. And that calculation would give you return on equity, or ROE, not ROCE. Comparing is the only way to survive the profitability section of the syllabus?
Okay, so now that we've saved you from the biggest trap in the syllabus, let's lock in your exam strategy.
Mm.
If we know the pitfalls, how do we build an actual advantage?
We can pull 3 specific, actionable exam techniques directly from the examiner's reports. These are the insider tips that separate the students who pass from those who don't.
Let's hear them. Tip number 1.
Tip 1, the ROCE trick. Always remember the mathematical algebra we discussed earlier. ROCE equals operating profit margin multiplied by asset turnover.
Right, the 5 times 2 equals 10 thing.
Exactly. This is crucial for the exam because if a question only gives you 2 of those figures, you don't need to panic. You can always use basic algebra to find the missing third figure. It functions as a built-in safety net.
I love that. It's like having the answer key hidden inside the question itself if you just know how to rearrange the formula. What is tip number 2?
Tip 2, the acid test filter. When you are calculating the quick ratio, which is widely known as the acid test, you must always remember to subtract inventory from your current assets.
Right, because as we talked about earlier, inventory might take months to actually convert into cash. You can't pay your immediate electric bill with a warehouse full of unsold T-shirts.
Exactly. The examiner wants to see if you understand the reality of cash flow. A healthy, fast-moving operating cash flow can often compensate for what looks like weak liquidity on paper. By deliberately excluding the inventory, you strip away the illusion and find the true, immediate liquid health of the business.
Keep the inventory out of the acid test to see if the patient is actually breathing. Got it. What is tip number 3?
Tip 3, the gearing rule of thumb. Capital gearing measures a company's relative levels of debt versus its equity. You need to remember that a large proportion of borrowed capital is inherently risky. Why? Because interest payments and capital repayments are strict legal obligations.
Yeah, if you don't pay the bank, they take your business.
Exactly, you go insolvent. The payment of an equity dividend to shareholders, however, is not a legal obligation. You can pause it if cash is tight.
But wait, companies take on massive amounts of debt all the time on purpose. It must be attractive to them in some way, right?
It is highly attractive, and that's the risk-reward trade-off you have to explain. Interest payments on debt are tax-deductible, whereas equity dividends are paid out of after-tax profits. Furthermore, lenders usually accept a lower rate of return than equity investors because their loans are often secured against company assets. They are safer.
So debt is cheaper, and it saves you on taxes, but it puts a gun to the company's head if revenues drop. So how do we measure when it's too much?
The golden rule of thumb for your exam analysis is this. Gearing is considered too high when the proportion of debt exceeds the proportion of equity. If debt is higher than equity, the financial risk dashboard is flashing red, and you need to highlight that in your written answer.
Wow. Okay, these 3 techniques alone, the ROCE algebra trick, stripping inventory for the acid test, and watching for debt to eclipse equity, are going to completely change how you approach these exam questions.
They really will.
And I just want to pause here and say, if you are a younger listener, maybe you are studying for your FMA or MA right now on that crowded commuter train, do not let this wall of formulas intimidate you. You are simply learning the language of business.
Absolutely. And for those of you who are already working, the experienced professionals stealing time on your lunch break to upgrade your qualifications, mastering these ratios means you aren't just reporting history. You are the person in the room diagnosing the future of the company.
So next time you stare at a dense page of raw financial numbers, remember, you aren't looking at a Mac test. You're looking at a corporate mystery. And now, you have the exact tools you need to solve it.
If you take only one thing away from this deep dive, let it be this. Formulas tell you what happened. Ratios tell you why it matters.
Yes. To our global audience, thank you. We know you are balancing real careers, real families, and real lives while pushing through the rigorous ACCA qualification. We see that hustle, and we genuinely appreciate you choosing to spend your valuable time with us today. If this deep dive helped you decode the syllabus, please follow the show on Spotify and leave us a review. It really helps.
Keep questioning the numbers and always look for the hidden story behind them.
Thank you for listening.